It's time to talk about the hedge fund so smart it almost destroyed global finance. Meet long-term capital management, or as I like to call it, math nerds gone wild. The dream team had it all. The team had not one Nobel Prize winner, but two Nobel Prize winners, Myron Scholes and Robert Merton. Yeah, the Black-Scholes guys. The same formula that prices your options, price their downfall. They were betting that small price differences between bonds would eventually even out. This is called convergence trades. The only problem is these mispricings are very small. To make real money off these tiny spreads, the fund borrowed like crazy. They had 125 billion in assets and only $5 billion in capital. That's a leverage ratio of 25 to 1. Normal stuff if you're trying to speed run bankruptcy. Meanwhile, in Russia, the government was running persistent fiscal deficits financed by short-term debt. As investors grew skeptical of the government's ability to meet its obligations, capital flight from Russia intensified. In response, U.S. markets panicked and every trade long-term capital management had made blew up in unison. Correlations went to 1 and liquidity vanished overnight. And suddenly, the world's smartest fund was losing $500 million a day. The collapse was so bad that Wall Street had to call the Federal Reserve for a $3.6 billion bailout. The Fed agreed just to stop the domino effect from taking down the entire global banking system. So what do we learn? Simple. Leverage kills. Models lie. And never give Nobel Prize winners $1 billion and a spreadsheet. Stay hedged, my friends, or at least stay less leveraged.